Have you ever experienced a loss in your crypto investment? If so, you're not alone. The world of cryptocurrency is a roller coaster ride filled with thrilling highs and terrifying lows. It's a world that can bring vast fortunes overnight, yet can just as swiftly wipe them out. It's unpredictable, volatile, and can sometimes seem like a game of chance. But here's the thing. Losses, though painful, are part and parcel of the game. They're the tuition fees you pay on your journey to becoming a seasoned crypto investor. The key, however, is not to avoid losses entirely. That's an impossibility in any investment landscape. The real goal is to minimize them, to manage them in such a way that they don't derail your entire investment strategy. So how can you avoid or minimize these losses? Let's dive right in. The first step in avoiding loss is understanding the market. The crypto market, like any other, is driven by supply and demand. But what sets it apart are the rapid fluctuations, the high volatility, and of course the technological complexity. So how do we navigate these choppy waters? Market research. It's an essential tool for anyone looking to venture into the crypto world. It helps you understand the trends, identify opportunities, and predict potential pitfalls. Think of market research as your compass, guiding you through the vast ocean of cryptocurrencies. But where do you start? Luckily, there are numerous resources available at your fingertips. CoinMarketCap is a great place to start. It's a platform that provides real-time data on the performance of various cryptocurrencies. It's not just about the price, it's about the market cap, the trading volume, and the supply. These are key indicators that can give you a broader picture of a coin's performance. Then there's the news. Staying updated with crypto news can give you insights into market trends and potential shifts. Look for reliable sources that cover everything from government regulations to technological advancements. These can have a significant impact on the crypto market. Online forums, too, can be a treasure trove of information. They're a place where like-minded individuals share insights, discuss trends, and even warn of potential risks. But remember, while forums can be helpful, they can also be a breeding ground for misinformation. So take everything with a grain of skepticism. Finally, don't forget about the white papers. These are documents released by crypto projects that detail their concept, technology, and plans. Reading white papers can give you a deeper understanding of a coin's potential and whether it aligns with your investment goals. In conclusion, understanding the market is not just about following the price. It's about understanding the forces that drive it, the trends that shape it, and the risks that come with it. It's a continuous learning process, a journey, not a destination. Remember, knowledge is power. Understand the market before you dive in. Next, you need to diversify your portfolio. This isn't just a buzzword, it's a fundamental principle of smart investing. But what does it really mean? Diversification is the practice of spreading your investments across various types of assets to reduce risk. Think of it like a buffet. You wouldn't load up your plate with just one kind of food, right? Similarly, in the world of cryptocurrencies, it's not wise to stake everything on a single crypto. Why? Well, the crypto market is notoriously volatile, prices swing wildly, and fortunes can be made or lost overnight. By investing in a range of different cryptocurrencies, you can spread the risk. If one crypto crashes, others in your portfolio may still be performing well, cushioning the blow of any potential losses. Remember, diversification isn't about chasing the next big thing, it's about striking a balance. Don't put all your eggs in one basket, diversify your portfolio to minimize risk. Now let's talk about smart investment strategies. When it comes to investing in crypto, there are a few strategies that can significantly reduce your risk. Let's delve into some of these and see how they can help you avoid losses. First up is dollar cost averaging. This strategy involves investing a fixed amount of money in a specific cryptocurrency at regular intervals, regardless of its price. By doing so, you're effectively spreading your investment over a period of time, which can help mitigate the volatility of crypto markets. Imagine you're investing $100 every month. Sometimes you'll buy when the price is high, sometimes when it's low. Over time, these highs and lows average out, potentially reducing the impact of short-term price fluctuations. This strategy is particularly useful for those who want to invest in crypto without constantly monitoring the market. Next, we have stop-loss orders. This is a strategy where you set a predetermined price at which you'll sell your crypto to avoid further losses. For instance, if you bought a coin at $10 and set a stop-loss order at $8, your coin would automatically be sold if the price falls to $8. While this might mean selling at a loss, it also prevents you from holding on to your investment as the value continues to plummet. It's like an emergency exit, safeguarding you from severe downturns. Lastly, let's talk about taking profits. It's easy to get caught up in the excitement of a bull run, but it's crucial to set targets for taking profits. It's not about timing the market perfectly, but about securing profits when you can. Remember, it's better to regret selling a bit early than regret not selling at all when the market crashes. The key is to have a plan and stick to it, rather than being swayed by market hysteria. Smart investment strategies can save you from significant losses. Implement them in your trading routine. Unfortunately, the crypto world is full of scams and hacks. It's a harsh reality, but like a seasoned sailor navigating stormy seas, you can learn to spot the signs and steer clear of danger. Firstly, let's talk about pump and dump schemes. These are situations where an asset's price is artificially inflated, often through misleading or outright false statements. Once the price is pumped up, the fraudsters dump their holdings, causing the price to plummet and leaving unsuspecting investors high and dry. Avoid this by doing your homework. Don't blindly follow tips or recommendations, especially from sources you don't trust. Always research and make sure you understand what you're investing in. Next, we have fake initial coin offerings, or ICOs. These are fundraising methods where a company creates a new coin or token and sells it to investors. Scammers have been known to set up fake ICOs, collecting funds and then disappearing. To avoid falling victim, make sure to thoroughly research any ICO you're considering. Who is the team behind it? What is their track record? Are they transparent about their plans and progress? If something feels off, it probably is. Then there's phishing. This is when scammers attempt to trick you into giving them your private keys or login details. They might do this through fake emails, websites, or even social media messages. Always double-check the source and never give your private keys to anyone. Lastly, let's talk about securing your crypto wallets. It's crucial to use strong, unique passwords and enable two-factor authentication whenever possible. Also, consider using a hardware wallet which stores your private keys offline and is therefore less vulnerable to hacks. Remember, in the world of crypto, knowledge is your best defense. Never rush into an investment and always be on the lookout for potential scams. The crypto world is exciting and full of opportunities, but it is also fraught with risks. Stay vigilant. Protect your investment from scams and hacks. So we've covered a lot today. We dove headfirst into the unpredictable world of crypto, where change is the only constant. We emphasized the importance of understanding the market, how it ebbs and flows, and how it's influenced by a myriad of factors. It's essential to be informed, to stay updated, to keep your finger on the pulse. Knowledge is power, and in the world of crypto, it can be the difference between a wise investment and a costly mistake. We also discussed the necessity of diversifying your portfolio. Just as you wouldn't put all your eggs in one basket, you shouldn't invest all your funds in one cryptocurrency. Diversification not just dilutes risk, but also opens up opportunities for growth in different sectors. It's a wise strategy that can help buffer against market volatility. Next, we delved into smart investment strategies. Remember, it's not about hopping onto the latest trend or following the crowd. It's about doing your homework, making informed decisions, and being patient. It's about knowing when to hold and when to fold. Investing in crypto isn't a sprint, it's a marathon. And lastly, we highlighted the importance of vigilance against scams and hacks. In this digital age where transactions happen at the click of a button, it's crucial to be mindful of where and how you invest your money. Always verify before you trust, and don't let the promise of quick gains cloud your judgment. In the end, remember this: crypto isn't a get-rich-quick scheme. It's a dynamic, evolving field that demands time, effort, and a good deal of patience. It's a journey, one that can be incredibly rewarding if navigated wisely. So keep learning, keep growing, and keep making smart decisions. And remember, no matter how technologically advanced we become, the age-old wisdom still holds true. Don't invest more than you can afford to lose. Remember, investing in crypto is a journey. It's not about getting rich quick, it's about learning, growing, and making smart decisions. Good luck on your crypto journey.